This is Japanese Economic Review Channel. This time, let's take a look at SBI Securities' domestic weekly outlook.
Glad to be here.
Yeah, we're really glad to have you back. Imagine trying to steer a bullet train while someone else, controls the brakes.
Oh, that sounds like a nightmare.
Right. But that's exactly what the Bank of Japan is dealing with this week as these macroeconomic shockwaves from the Strait of Hormuz just kind of crash into our domestic inflation data.
Yeah, it's a huge collision of forces right now.
Definitely. And if you're tuning into the broadcast today, you're likely looking for a shortcut to being well-informed for the days ahead. I mean, that's our mission here. We're taking a comprehensive deep dive into the latest domestic weekly outlook.
We want to see what's actually moving the markets.
Yeah.
Okay?
Exactly. Where the hidden risks lie and how you can position your portfolio.
What's fascinating here is how vividly global geopolitics are dictating the terms for domestic Japanese portfolios right now. I mean, you can't analyze a single stock in Tokyo this week without understanding the friction happening thousands of miles away.
No, you really can't. And to make sure we cover all the bases without, overwhelming you with information overload, we've broken today's deep dive into 3 distinct parts.
Makes it easier to digest.
Yeah. So first, we'll look at this week's stock market outlook, really focusing on the heavy macroeconomic clouds hanging over the Nikkei. Second, we'll pivot to key factors and foreign exchange. We need to understand that fierce psychological tug-of-war happening with the yen right now.
Oh, the yen is just wild right
It
now.
really is. And finally, we'll walk you through the weekly timetable. We'll detail the specific day-by-day events you need to circle on your calendar.
Perfect.
So let's look at the baseline data from the source material so you know exactly where we stand. The Nikkei 225 dropped 447.08 points.
Wow.
Yeah, landing at 53,372.53. Meanwhile, the TORPX fell slightly by 19.63 points to close at 306.09.40.
So we're looking at a market that is decidedly in the red. And it's a highly volatile red, too. It's driven by a very clear catalyst, which is the ongoing conflict in the Middle East, specifically involving the U.S., Israel, and Iran.
Okay, let's unpack this. Because understanding the mechanics of why a geopolitical conflict translates directly into your portfolio dropping is crucial.
Right. People need to see that connection.
Think of Japan's economy like a massive hydroponic farm. It produces these high-value, incredible crops, but the water comes from a single hose thousands of miles long.
I like that analogy.
Right now, there's a severe kink in that hose at the Strait of Hormuz. And because of that choke point, NY crude oil futures are spiking right back up to the $100 per barrel level.
And when the cost of that essential input skyrockets, I mean, the profit margins of almost every manufacturing and logistics company in that hydroponic system, they shrink immediately.
Exactly. But before we go any further, I want to make a quick note for you listening. We are reporting on the conflict between the U.S., Israel, and Iran strictly as factual events affecting the markets.
Yes, very important point. We aren't taking any political sides here. Our focus is purely on analyzing the economic ripple effects detailed in the SBI Securities report.
Right, completely neutral. We're just following the money. So the market's primary anxiety right now is timeline. How long does this supply chain disruption actually last?
And the report gives us an interesting geopolitical framework for that.
Yeah, it notes that U.S. President Trump has been shifting his timelines regarding a resolution. He even postponed a planned trip to China.
Which signals to the market that a ceasefire isn't exactly imminent.
No, not at all. A quick resolution seems off the table.
But the report does highlight a compelling macro incentive that might cap how long this drags on.
Oh, right, the anniversary.
Yeah. The U.S. is approaching the 250th anniversary of its independence on July 4th. The implication here is that the U.S. government has this massive internal domestic motive to resolve the conflict.
To stabilize the global economy by the summer, basically.
Exactly. So they can celebrate that milestone under favorable conditions.
That makes a lot of sense. So if that timeline solidifies and the market starts pricing in a resolution within, say, 4 to 6 weeks, we might actually see the market rally.
Because institutional investors crave certainty. Even if that certainty is a month away, they can model it.
Right. But if it drags on past that, the report warns of this thing called pessimism fatigue setting in.
Oh, that's a great term for it.
Yeah, it's just this general grinding exhaustion that pulls equity valuations down across the board. People just get tired of waiting for the bad news to end.
And that fatigue is heavily compounded by the biggest threat on the board right now, which is stagflation.
Right.
This is why this particular market dip is so vicious. We aren't just dealing with a slowing economy. We're dealing with an oil-driven inflation spike happening at the exact same time.
Which completely paralyzes the central banks. I mean, they're trapped. They can't stimulate the slowing economy because doing so would just throw gasoline on the inflation fire.
Yeah, exactly. This is why we saw Federal Reserve Chair Powell emphasize caution about inflation risks at the recent FOMC meeting. He kept rates steady.
And we saw the exact same posturing from Bank of Japan Governor Ueda.
We did. He kept the BOJ policy rate steady, but explicitly warned that higher crude oil prices could force their inflation forecasts to be revised upward.
They're essentially telling the market, look, the era of cheap money bailouts is on pause while we fight this supply-side inflation.
Yeah, you're on your own for a bit.
So bringing this back to your portfolio, the report gives us an expected range for the Nikkei this week of 52,000 to 55,000 yen. But if this Middle East situation turns into a prolonged stalemate, the recent low of 51,407 could act as the hard floor.
Investors are taking a highly defensive posture right now. They're hypersensitive to any headline out of the Middle East.
Definitely. And if 51,400 is our hard floor for the equities market, I mean, the pressure has to escape somewhere, right?
It always does.
Right now, that release valve is the currency market, where the yen is just being torn apart. So let's pivot to our second section. Key factors and foreign exchange.
The currency dynamic is fascinating right now.
It is. The expected range for the US dollar to Japanese yen this week is 156.0000 to 161.00. That is a massive volatile spread.
Early last week, we saw some geopolitical tension ease slightly.
Yeah.
That caused crude oil to pull back, and the dollar fell with it.
Yeah.
But the real volatility trigger came when Japanese Finance Minister Katayama warned that the government is ready to take resolute measures.
Ah, resolute measures. That's the classic diplomatic code phrase for currency intervention.
It sure is.
When the finance minister says resolute measures, they're reminding institutional traders that the government will step in to buy yen if it weakens too rapidly.
It's basically a verbal warning shot across the bow of currency speculators, like, back off.
Yeah, exactly. So what does this all mean? Here is where I want to push back a little on the mechanics with you.
Sure, go for it.
If both the Federal Reserve and the Bank of Japan decided to hold their interest rates steady recently, why is the currency still bouncing around so violently? I mean, if the actual policy didn't change, why is the price swinging 5 yen in either direction?
That's a great question. Currency valuation isn't just about what rates are today.
Yeah.
It's heavily weighted on what the market believes rates will be tomorrow.
Ah, okay. The expectation.
Right. On the U.S. side, you have sticky, stubborn inflation driven by that Middle East oil dynamic we talked about. When inflation is sticky in the U.S., traders assume the Fed will keep rates higher for longer.
And high U.S. rates attract global capital.
Exactly. That drives dollar buying, which pulls the USD-JPY rate up toward that 161.00 ceiling.
So the market is pricing in the yield differential, but then the Tokyo market is reacting to the nuance in BOJ Governor Ueda's statements, right?
Yes, precisely. Even though he held rates steady, he dropped strong hints about future rate hikes if inflation overshoots.
And traders hear that, they price in a stronger yen down the road, and boom, they pull the dollar back down.
It's a pure collision of expectations. You have U.S. inflation pulling the dollar up, and the threat of BOJ rate hikes pulling the yen up.
A literal tug of war.
Yeah, and technically speaking, the report notes that the floor for this tug of war is settling around the 25-day moving average, which sits right at that 156.000 mark.
Okay, so since the major central bank meetings are safely in the rearview mirror now, I guess the market's obsession is shifting entirely to the raw data.
Oh, absolutely. Traders are going to be glued to the upcoming U.S. inflation and employment data to see who is actually winning that tug of war.
So the data released this week will dictate exactly how those broader macro trends play out in real time.
Yes.
Well, let's apply this macro knowledge to the immediate future in our third and final section, the weekly timetable.
Let's get into the schedule.
What are the specific events you need to circle on your calendar this week? Let's dive deep into the day-by-day breakdown. Starting with Monday, the report highlights a pretty fascinating microeconomic detail.
I love this part of the report.
Right? JR East, ticker 9020, is introducing luggage-only cars on the Tohoku Shinkansen.
Yeah, a passenger rail company monetizing empty space for freight. That is a glaring macroeconomic indicator of supply chain stress.
It really is.
With the 2024 problem in Japan, Specifically, those strict new overtime caps for truck drivers causing severe labor shortages in logistics companies are being forced to adapt.
They have to find new ways to move things.
Exactly. Utilizing the bullet train network for freight speaks volumes about the resilience and really the necessary evolution of domestic infrastructure.
It perfectly shows how macro-level demographic and regulatory problems force micro-level corporate solutions.
It does.
Moving to Tuesday, we hit a massive wall of data. Domestically, Japan releases its February Consumer Price Index, or CPI.
Big one.
We also get the nationwide department store sales data, and there's a 40-year Japanese government bond auction.
That Japan CPI data is the undisputed headliner of the week.
Why is it so critical right now?
Well, connecting this back to the currency tug-of-war we just discussed, the BOJ is desperate for evidence to justify those future rate hikes. The CPI is basically their ultimate report card.
Okay, I see.
If service sector inflation comes in hotter than expected, the market will instantly price in a higher probability of a BOJ rate hike. You'll see that currency rope snap violently in favor of the yen.
Wow, okay. And then the department store sales data will kind of act as a reality check alongside that, right?
Yeah, exactly. It'll show us if consumers are actually absorbing that inflation or if spending is just contracting entirely.
And watching a 40-year JGB auction in an inflationary environment is just wild to me.
It's intense. We'll see exactly what kind of yield life insurers and pension funds demand to lock up their capital for 4 decades right now.
4 decades. That's a lot of commitment. Tuesday is also huge overseas, by the way. It's Global PMI Day.
Yes, very busy.
We have the Eurozone HEOB Manufacturing PMI and the US S&P Global Manufacturing PMI. Plus, Xiaomi is releasing earnings in Asia.
Those PMIs are crucial leading indicators. The Eurozone PMI will show us the hangover effects of their own energy crisis,
Right.
while the U.S. PMI will really reflect domestic manufacturing resilience. If those U.S. figures show a sharper slowdown than expected, it could actually ease some of those sticky inflation fears.
Which, again, cascades directly into the currency markets.
Exactly. And Xiaomi's earnings will serve as an excellent proxy for Asian consumer tech demand and smartphone replacement cycles.
Good to know. Okay, rolling into Wednesday, this brings the release of the BOJ's January meeting minutes. We also have 2 new domestic IPOs hitting the market.
Oh, the IPO.
Yeah, we've got J Pharma, ticker 520A, and Basic, ticker 519A.
So even though the BOJ minutes are from January, institutional traders will be parsing every single sentence to track the evolving sentiment of the dissenting board members.
They look for any breadcrumbs.
Exactly. As for the IPOs, launching public offerings in a market paralyzed by stagflation fears and Middle East volatility is a massive test of market psychology.
It's a brave time to go public.
It really is. J Pharma, being a biotech, typically requires a low interest rate environment to fund its cash burn.
That makes sense.
So seeing how these two price and trade will tell us exactly how much risk appetite actually remains for domestic growth stories.
Right. It's a real-time sentiment gauge. Overseas on Wednesday, we're looking at the German IFO Business Climate Index and U.S. import and export prices. Germany is the industrial engine of Europe, so if the IFO index shows contraction, it bodes pretty poorly for global aggregate demand.
Very poorly.
Meanwhile, the U.S. import and export prices will reflect the increased shipping costs caused by the Red Sea and Strait of Hormuz disruptions, which feeds directly back into that U.S. inflation narrative we keep hitting on.
It all connects back to the oil and shipping lanes.
It always does. Okay, on Thursday, Japan releases the Corporate Services Price Index at 8:50 a.m. Overseas, the U.S. is holding a 7-year note auction, and we have Ping and insurance earnings in Asia.
The Corporate Services Price Index, or CSPI, is the vital B2B inflation metric.
Right, between businesses.
Yeah, it tracks the inflation of services between corporations before those costs are ever passed down to the consumer at the retail level.
So it's an early indicator.
Exactly.
Yeah.
If the CSPI spikes, it's a glaring early warning system that retail inflation is going to remain sticky in the coming months.
Got it. And Ping An's earnings.
That will give us a very clear window into the broader health of Asian credit and real estate markets.
Okay, moving to Friday. Here's where it gets really interesting for domestic investors. Friday is the end of March ex-dividend date. This is a massive structural milestone for the market.
It is, and it dictates entirely artificial volume and price movement.
How so?
Well, because investors must own the stock before this date to capture the dividend yield, you see a massive rush of institutional rebalancing and buying early in the week.
Oh, I see.
Then on Friday, you'll see a mechanical drop in the Nikkei simply because those dividend values have been paid out and are no longer reflected in the stock prices.
Okay, so it's vital to know that mechanism so you don't panic if you wake up Friday to see sudden drops in dividend-heavy stocks.
Exactly. Don't panic. It's algorithmic, not fundamental.
Good advice. And to cap off this incredibly busy week, we have one more IPO on Friday. Sawa Holdings, ticker 523A.
You know, if we connect this entire timetable to the bigger picture, you can see the narrative of the global economy playing out chronologically.
Yeah, it really tells a story.
You start the week watching Japanese consumer inflation on Tuesday, which sets the expectation for the BOJ. By Wednesday and Thursday, the global PMIs and business costs give us the international context of the stagflation threat.
And it all culminates in a massive domestic capital reallocation on Friday with the ex-dividend date.
Exactly.
So to summarize the core value for you, our listener, heading into these next few days, you are navigating a market that is highly reactive to oil-driven stagflation fears stemming from the Strait of Hormuz.
Yes.
Keep a very close eye on that 156 to 161 yen currency battleground, remembering the psychological tug-of-war between sticky U.S. inflation and BOJ rate hike expectations.
That's the key friction point.
And finally, stay sharp on Tuesday's CPI data, which will set the tone for a relentless data calendar, all leading up to Friday's major dividend deadline.
As a final thought for you to mull over as we wrap up, consider how this extended period of currency volatility alters the landscape for corporate strategy.
Oh, that's an interesting angle.
We've talked extensively about the weak yen being a product of interest rate differentials. But if the yen remains suppressed at these 156 to 161 levels, do domestic, cash-heavy Japanese companies start aggressively stepping in to buy back their own stock at a discount?
Wow, yeah.
Or, more importantly, does this weak yen make Japanese companies prime targets for foreign takeovers?
That's a huge question.
The currency isn't just a number on a screen. It's effectively putting Japanese corporate assets on sale to the rest of the world. It's a space worth watching very closely as this macro environment drags on.
It certainly changes how you evaluate the defensive posture of these companies. So much to think about this week. Thank you for watching the Japanese Economic Review. We look forward to having you with us again.